I wouldn't expect the housing market to be the thing that creates the next recession or compounds the next recession, for the simple reason that people are going to have lots of equity in their houses. And so we'll have a very powerful incentive not to default. You'd need enormous price declines in order for this to happen. And I think, and I'll comment on this a bit later, I think the probability of enormous price declines is also quite small. So next slide, please. So I want to spend a little time talking about this issue of age and the share of people with mortgages. And I think it's correct that the principal reason that the share of people with mortgages is declining is that the share of the population that's old is increasing. And you see it with, but you do see, in fact, this impact of likely more cash sales that, other than the older cohorts, the younger cohorts are less likely to hold a mortgage than they were 10 years ago. But I want to talk a little bit about the elderly here, because I think it's something we need to think about and worry about. So remember that 38% number reflects everybody over the age of 65. And in fact, when you get over the age of 75, very few people have mortgages. And that share has continued to trend down, at least when we look at the Survey of Consumer Finances from 2013 to 2016, which are our most recent data. The share of 75-year-olds and above with mortgages was lower than it was 3 years earlier. But what we're seeing is well over half of people at age 65, according to the Survey of Consumer Finances, now in fact do have mortgages. And so we see this phenomenon that I think we're going to need to worry about in the years to come, which is a substantially larger share of the elderly have a house cost to income ratio of greater than 30%. And that share has increased among renter households, but also substantially among owner households. And it is the result of two things. One is property taxes can be an issue. But the other thing is, again, 65 plus now have mortgages, and in years past they tended not to. In fact, if you go back to my parents' generation, the typical 65-year-old had no mortgage at all. And now, as I say, more than half of them do. And so as we're thinking of the pressures on the elderly, we're not only going to have to think about health care, so the stuff that Medicare doesn't cover, long-term care, for which there isn't particularly good insurance in the United States, and now also the housing burden faced by these folks. And I think this is going to be something to keep an eye on and something policymakers should be paying some attention to. One of the things that is striking to me is if we look at the share of, so two things. One, the share of originations that are being done by the private sector now is increasing, and I think people would argue that this is a healthy thing. We are starting to see a little bit of recovery in the private label market, and we are seeing more portfolio lending. But I think there are a couple of reasons to be also a little concerned about this. And first, I can't help but be amused that lenders tend to remain backward-looking. So if you think about the best time ever to have made a mortgage, it was probably 2010, because it was very clear that house prices had overshot. On the downside, if you look at the fundamentals like income and rent, house prices fell far, far more rapidly than those things did, and those other things did fall. And again, the mortgage underwriting standards were so tight that loosening them up, at least at the margin, or having the private label market come in or portfolio market come in at the margin, was almost certainly a great profit opportunity, because the probability of default at that time going forward was very low. Now we've reached a point where I think a couple of markets may be in bubbly territory. So I'm thinking in particular here of where I live in California, and by I don't want to say bubble, I mean bubbly, but again, if you look at house prices relative to incomes, relative to rents, they have outstripped them, and not by a lot, but by some. And I think that's a cause for concern. I don't think there's any reason to think there'll be a crash remotely like what we had 11, 12 years ago. But there's a chance of a small correction, and so this is the time you would think lenders would be more cautious. And of course, we're seeing that the opposite is true. And the reason for that is, okay, you look back now at 10 years of lending. As Lori alluded to, there's basically been no default on the last 10 years of books of businesses. I mean, not only have they been defaulted at low rates that were predictable given the measured underwriting criteria, the default rates has been lower than that. And I start to worry. People are saying, "Oh, look, there's no risk in making mortgages again," and so they're starting to get into the market. Maybe the time when risks are just, and again, I don't want to overstate the point, small risks are starting to creep into the market. The other thing I wanted to talk about was on this issue of profitability. Just stick with the profitability. Thank you. On the issue of profitability, one of the things our friends at the Mortgage Bankers Association spend a lot of time talking about is compliance costs. And if you look at this series, it does not have a component for compliance costs in it. And it's almost doubtless the case that Dodd-Frank has increased compliance costs, which is one of the reasons we've seen movement toward non-bank lending, I think. And if the non-bank lenders are bearing these costs but not recognizing them as costs at the time, that's something to be concerned about. And so I wonder if we looked at profitability from a really correct standpoint, whether it wouldn't be considerably lower than it is right now. And I think that's an issue worthy of further study. Okay. Next. Yeah, so I think the HPI stuff explains a lot about where we are in terms of new construction. So the new construction market is still, by historical standards, very weak. And in particular, if you do the following exercise, divide the number of new houses built by the working age population. So don't just look at total new housing built, where we're sort of still not quite at average for the last 50 years, but if you look at it divided by a relevant population number, like working age population, we are still near previous troughs in terms of new construction. We're slightly above them, but it's really astonishing to have had an economic recovery run this long and see so little new construction. And I think this chart may reveal a little bit of why that is. So as alluded to, we have markets such as Chicago, such as Riverside, such as Phoenix that haven't even come back to their previous peaks. But even look at a healthy market like here in Los Angeles, where we're 13% above peak right now. Well, think about the way people usually bought new houses is they would buy a starter home, which was usually an existing home, and then they would ride appreciation up, and they would have enough equity in that starter home in order to put a down payment on a new house. I bought my first house in 1988 for $89,000. I sold it 4 years later for $119,000. So basically, I got $30,000 of equity that I had to do no work whatsoever to do, which, along with my initial down payment, allowed me to buy my next house, which was, I mean, it wasn't that much, it was $130,000. But so now imagine you're a home buyer in New York, and you bought your house in the period 2004, 2005, 2006, and you're now 10, 11 years out. You've only accumulated 11% of equity relative to that original price, plus you paid down a little bit of your equity, but you haven't had that big increase in equity that allows you to move up. And this has been the case in the vast majority of our markets, and explains, I think, why you're seeing this sort of first-time market be very tight. I'm going to say a little bit more about that in a second, but also why there is a demand necessary to buy new houses, particularly given how expensive new houses are because of the regulatory requirements that are built into constructing new housing at the moment. Next slide, please. Okay, housing affordability. I think this measure, which is the NAR measure, was a very useful measure for a long, long time. I don't know how useful it is anymore, and there are two reasons for this. First of all, I think when we think about housing affordability, what we care about is can people buy their way into the housing market if they're not currently in the housing market. And so we're looking at first-time home buyers. And one of the things we know from Case-Shiller is that the bottom of the market, and FHFA, the bottom of the market has appreciated far more rapidly than the remainder of the market since the crisis. All sectors have appreciated, but the bottom third has appreciated more. And if you think about where that first-time home buyer is going for a house, they're probably going to that bottom third of the market. So perhaps the relevant house price to look at is not the median, but something like the 30th percentile or the bottom third or something like that. And I would be interested to see what affordability would look like if you did that. Secondly, what you probably want to look at is what are median renter incomes, or even the top quarter of the renter income distribution, because again, those are the people who are going to be candidates to be homeowners. But the other thing is this measure looks at DTI, only look at the mortgage, basically saying if your mortgage payment is 25% or less, then you can afford to buy the house. And I think because we're in an environment where interest rates are very low, but people have lots of other debt, that actually total DTI is the correct measure to look at for affordability. Because that's how you're, among other things, that's really how you're underwritten. As best as I could tell, front end, back end is not the way it's done anymore. It's all back end. So you total all of your credit obligations and ask if it's, if you're in the QM world, 43% or not. If you're in Fannie Freddie world, it could be more than that. And so thinking about using those underwriting standards and measuring affordability, I think, is critical. And then, of course, the San Francisco point, your down payment in San Francisco, you still need $35,000 down payment to buy a house, which is asking for a lot of money from a lot of people. And finally, this last one, I thought I had something to say, but Lori said it for me, because when we had the pre-call, we hadn't talked about prepayment, and I was thinking, because this is a mystery, you would think as vintages age, they get safer, and so spreads should get lower, but it makes total sense that if you have a vintage with slightly higher interest rates than that, the competition for prepayment has got to go up, and so Lori explained that quite well.
Well, thank you very much, Richard. That was absolutely fabulous. We really, appreciate your participating, and you provided us, a lot of very, very good background and food for thought. We had a number of questions submitted before the call, and I think what I'm going to do is first take the question on the QM patch. And then I'm going to turn it over to Michael, who's going to answer a few of the other questions, and then I'll take it back for the residual questions. So the question we got on the QM patch is, what would be the consequences of letting the GFC QM patch expire? As you all know, the Bureau came out with an announcement of proposed rulemaking last week, where they basically said, very aggressively said, we have no intention of extending the patch. We plan to let it expire on its planned expiration date or shortly thereafter. Despite that very aggressive wording, I think that they really don't have a very good sense of direction, and they're going to need to extend the patch for at least a year, likely two. And I wouldn't dismiss the fact that there's going to be a one-year extension followed by another one-year extension. First, it's pretty clear they have no intention of just letting the patch expire, putting nothing in its place. The bureaus did a very, very nice study in January of this year, where they basically said, in 2018, the GSEs guaranteed roughly 3.1 million loans. 31%, or 957,000, had DTIs greater than 43%. So that constituted 16% of all first lien residential originations in 2018 fall within the temporary patch. And this is the Bureau's own numbers. Then if you fall within the temporary patch and they let the patch expire, there are three paths for those loans. First is the FHA patch. Is those loans moved to the FHA? And nobody can possibly think that moving loans from the GSEs to the FHA represents any sort of a victory whatsoever. The second is that the private market capture those loans. And the third is the loans don't get made. The CFPB made it very, very clear that there's very little private market origination of loans with DTIs greater than 43. So that means likely a lot of these loans don't get made. They noticed that the higher DTIs were the result of both higher home prices and the higher interest rates that prevailed for most of 2018. As you read between the lines of the CFPB goals, the first is to put Fannie and Freddie on the same footing as the private market. So the CFPB definitely wants the GSE advantage, if you will, to go away, but they also want to put new rules in place. The problem is that they don't know what rules they want to put in place. The question is, should the CFPB retain a direct measure of consumers' personal finances in setting the QM, or should it adopt some indirect measure? We and a number of others have proposed using a market definition. That is, if the interest rate on the loan is less than 150 basis points over the PMMS rate, then it should be QM eligible. So the question is, what do you use as the QM demarcation? And there's no consensus on that. So let's think about timing. The patch expires in January of 2021. The CFPB should have final rules in effect about 1 year in advance, or January of 2020. We think this is impossible because this is an ANPR, that is an announcement of proposed rulemaking, not a notice of proposed rulemaking. Moreover, as I said earlier, it seems to lack direction. That is, they don't know what direction they want to go. They don't know if they want to retain a measure of the consumer's personal finances, or if they want to go in a different direction to measure a borrower's financial health. They're asking questions. Should we use DTI as the cutoff? If so, what should the number be? Maybe we should look at residual income. Oh, come to think of it, we don't know a lot about residual income. Maybe we should consider a different approach, like the 150 basis point markup that the Urban Institute, the Center for Responsible Lending, and the Housing Policy Council have proposed. What do we do about Appendix Q? The only thing that's been ruled out is extending the patch permanently, but we already had that information because there's certainly that clear desire to put the GSEs on an equal playing field with the private markets. Given what I think is a lack of direction, that is, in terms of what you want to replace the patch with, they're going to need at least a year extension. I mean, I think, their own work shows that they can't just let the patch expire and do nothing. Something has to be put in its place. They've spent a lot of time in the ANPR outlining the options. I think they're going to need at least a 1 year extension. If everything works smoothly, which it never does in DC, this has a 45-day comment period after the publication in the Federal Register, and this might get extended. It'll take them 9 months to come out with an NPR and another 6 to implement it. So best case, if everything goes perfect, they're out with the final set of rules in early 2021, effective in 2022. More likely, it'll take a little bit longer to agree on a sense of direction, and certainly there's no consensus, and further extensions are likely. So I'm not very optimistic that they're actually going to be able to get, I'm very pessimistic they're going to be able to get a final set of rules in place before the patch expires, and the most likely route is a 1 year expiration of the patch, and possibly even longer than that. I think it's just a very, very difficult problem with a lot of implications and a very, very important issue. It's just going to take a little bit longer. So with that, Michael, why don't you
thanks, Lori.
Answer some of the other questions we've gotten.
Yeah, thanks, Lori. So there has been, obviously, there's a lot of question around rates, where mortgage rates will end up by the end of the year, and what that means for affordability. To a degree, I'm going to piggyback on some of the comments that have already been made, but then to another degree, I'm going to try to talk about rates from a slightly different perspective as well. So thinking about rates, obviously, I want to start off by saying that we're not a forecasting shop. We do not produce forecasts, including forecasts of interest rates. But our peers in the housing industry, specifically shops like the National Association of Home Builders, Freddie Mac, Fannie Mae, the mortgage bankers, they all do. They all kind of have circled around an expectation that the 10-year Treasury will average around 2 to 2.25%, 2.3% or so, over the course of this year, with the 30-year fixed being anywhere between 3.9% to 4.2%. I think it's fairly common knowledge that the 30-year fixed rate mortgage tracks the 10-year Treasury rate quite closely. But that relationship does allow us to kind of think about kind of what's going on with regards to interest rates. And so while I'm not going to necessarily provide a forecast because that's not something we work on, I will give you kind of some ways that I think about this issue in hopes of kind of illuminating the topic. So one way is to kind of just think about the 10-year Treasury in terms of what you think is going to happen in the short term and what you think is going to happen in the long term. The short-term federal funds futures have indicated anywhere between 2 to 3 rate cuts between now and the end of the year. That would put downward pressure on the short end of the curve, principally the 3-month Treasury bill, but the 2-year as well, which all else equal within lower the 10-year Treasury rate. At the same time, though, over time, you can think about the 10-year in terms of what you think about productivity growth and what you think about population growth. And to the extent that you've seen a level of stagnation in both of those, and to the extent that you think that population growth is going to slow, then that would ultimately put downward pressure on the 10-year Treasury, thereby lowering the 30-year fixed rate mortgage. Again, all else being equal. But another way to think about the 10-year Treasury is to think about is to answer questions about real economic growth, as well as consumer inflation. And so while one might think that broader economic growth is likely to slow, that's kind of implicit in commentary by the Federal Reserve. There might be some reasons why you think consumer inflation might accelerate. One reason for that, all else being equal, is that we did have a collapse in oil prices at the end of last year. And so it's going to take about 12 months for that collapse to wash out, and then for the pace of inflation to maybe pick back up again. So that would be one reason why one upside reason for the 10-year Treasury. And then finally, and I'll admit I think this is a lower probability, but we might see some resolution around macro issues with regards to trade and other issues and other geopolitical issues, slower global growth. If we were to see growth across Europe and China begin to improve markedly, or we saw some resolution around trade, that would have the effect of pushing up the 10-year Treasury. So the point is, these are kind of what the forecasts are, at least in the housing industry. Taking kind of a macro approach, I think these are kind of the upside and downside risks to rates. And so then that takes us nicely to what one thinks about affordability. Naturally, rates have fallen, and so that has helped to improve affordability, at least when it's measured by the National Association of Realtors Housing Affordability Index. That being said, though, I think, and this is piggybacking on a point that Richard made earlier, the impact on affordability is not going to be uniform. Some places, particularly those in the coasts, are going to see a less of an improvement in affordability, in part because house prices have risen so much more dramatically there. But then also when we look at the age distribution, younger households may feel may feel less of an impact on affordability, in part because, as has been shown earlier, the supply of homes remains low, particularly the supply of affordable homes. Another reason why that might be the case is that we have seen this shift in tenure, from owner-occupied in the single-family space, from owner-occupied to to renter-occupied, has largely taken place among homes among smaller homes, those where the square footage is 2,000 and less. These are typically exactly the kinds of affordable homes that younger households would be looking for. So the point there is that even though we've seen a reduction in mortgage rates, which should improve affordability, if affordable housing just isn't there, then that's going to make it difficult. To still see an uptick in home sales.
Thank you. Let me actually answer one other question. If mortgage rates stay low and the Fed cuts twice this year, how is that going to affect the relative volumes of cash-out refis and HELOCs? Well, if interest rates go down, we would expect the cash-out refi. If mortgage rates go down, we would expect the cash-out refi share to decline, but the amount of refis, both cash-outs and rate-term refis, to rise. If rate-term refis rise, we would expect the volume of HELOCs to go down. That is, if it's more economic to do a cash-out refi, and cash-out refis are available to a broader base of people. HELOCs require very, very high credit scores. So to the extent it's more economic to do a cash-out refi, and to the extent that cash-out refis are make more sense, or more broadly available, we would expect actually to see cash-out refi dollar amount up and the dollar amount of HELOCs down. Why don't we see if there are any questions meanwhile, any additional questions? Meanwhile, let me actually go over some of our recent work. Since our January call, we've hosted a sunset seminar on administrative reform of the GFCs and a data talk on the Black home ownership gap. We've also released 5 research briefs: fintech innovation in the home purchase and financing market, fast prepayments of VA mortgages are increasing costs to veterans and FHA home buyers, a comment letter on the Home Mortgage Disclosure Act, the state of and barriers to minority home ownership, and building Black home ownership bridges. We've also released 10 blogs, the 3 most popular: American seniors prefer to age in place, but what is the right place? The newest housing data indicate we likely aren't in a housing bubble, and housing affordability is a big problem. Small dollar mortgages could help. Our 2 most recent blogs: Private mortgage insurance reduces the severity of losses for those holding risk, and yesterday, these 5 facts reveal the current crisis in Black home ownership. And we've pulled together a landing page where we'll be hosting all of our work related to the racial home ownership gap, which you can find by going to the project link on the Housing Finance Policy Center landing page. In the coming weeks, we'll be blogging about the new single security and investors in single-family homes, and releasing research on seniors and mobility, and more about the gap in Black, white, and Hispanic home ownership rates. Once the new HMDA data is released at the end of August, we'll update our interactive map to show the latest 18 years of mortgage originations by race and geography. And please mark your calendar for Wednesday, October 23rd, when we'll host our 6th annual Housing Finance Symposium, Reimagining Housing, Closing the Supply and Equity Gap. With that, are there any final questions on the call?
We do have one. The question is, could you discuss the 10 basis point GP difference between Fannie and Freddie?
That is an excellent question. And, I don't have a very good answer to that.
No additional questions after that.
Okay, thank you all very much for joining our call today. Really appreciate it. and we'll talk to you next quarter. And Richard, thank you again for doing such a fabulous job. Really appreciate it.
Always a pleasure to be with you, Lori.
Take care.
Bye-bye.
Where'd you get a question?